Most traders believe that if they are still struggling, it means they have not yet found the right method. They assume that somewhere out there is a cleaner setup, a clearer confirmation, a more precise rule that will finally remove doubt. So they search, they refine, they adjust indicators and time frames. They believe the discomfort they feel after a loss is evidence that something external is missing. But what if the discomfort is not a flaw in your strategy? What if it is a signal from your nervous system? You sit in front of your screen after another losing trade. You followed your rules. You waited. You sized correctly. You did what you were supposed to do, and still you lost. In that moment, something tightens in your chest. Your breathing changes slightly. Your thoughts speed up. You begin searching for a reason. Not because you need information, but because your body is trying to escape uncertainty. This is where most traders misunderstand the painful phase. They think the pain is about money. It is rarely about money. It is about loss of control. It is about identity. It is about the shock of realizing that effort does not guarantee reward in this environment. In normal life, preparation improves outcomes. Study harder and you score higher. Train more and you perform better. Trading does not operate under the same emotional contract. You can prepare perfectly and still lose. The mind resists this because it threatens the belief that control equals safety. When a trade loses, the nervous system does not interpret it as a neutral probability event. It interprets it as risk exposure. Risk exposure activates alertness. Alertness narrows perception. Narrow perception increases urgency. Urgency weakens discipline. And then the next decision is no longer made from clarity. It is made from activation. The painful phase is not a test of intelligence. It is exposure therapy for uncertainty. Early in trading, there is excitement. Excitement feels like confidence. It feels like engagement. But physiologically, excitement and anxiety are close relatives. Both elevate heart rate, both sharpen focus, both increase dopamine. The brain does not clearly distinguish between opportunity and threat. It simply registers intensity. That intensity creates attachment. The outcome of the trade becomes personal. If it wins, you feel validated. If it loses, you feel diminished. The market has not changed you. Your interpretation has. The deeper struggle is not about being wrong. It is about what being wrong means to you. If your identity is built on being capable, on being sharp, on being disciplined, then a loss feels like contradiction. The mind wants to resolve that contradiction quickly. It looks for reasons. It looks for adjustments. It looks for certainty. That search feels productive, but often it is avoidance. Avoidance of sitting with the simple truth that you cannot control outcomes. The professional shift begins when you stop trying to eliminate uncertainty and start regulating your response to it. Regulation is quieter than motivation. It does not feel powerful. It feels stable. It is the ability to notice the tightening in your chest without reacting to it. It is the ability to let a losing trade close without immediately planning how to recover it. It is the discipline to keep position size small enough that your nervous system remains calm. Small size is not about caution. It is about clarity. When risk is small, the body stays neutral. When the body stays neutral, perception remains wide. When perception remains wide, decisions improve. This is not theory. It is physiology. Most traders try to think their way into discipline. They repeat affirmations about probabilities. They remind themselves that losses are normal. But if the risk is large relative to their emotional tolerance, the body overrides the logic. The heart rate rises. The palms sweat. The urge to interfere increases. In that state, you are not executing a plan. You are managing stress. Consistency is built in a state of low activation. This is why the painful phase feels long. You are not just learning rules. You are recalibrating your relationship with risk. Every loss challenges your old identity. Every win tests your restraint. Every sequence of randomness exposes attachment. There is a subtle moment before every impulsive action. It is brief, a flash of discomfort, a thought that says this cannot be happening again. That moment is where transformation lives, not in the outcome of the trade, but in the response to that internal surge. If you override your plan in that moment, you reinforce instability. If you pause and allow the discomfort to exist without acting on it, you build regulation. Regulation does not mean suppressing emotion. It means allowing sensation without being directed by it. When you accept that each trade is one event inside a large sample, something shifts. The trade loses its emotional weight. It becomes data. You execute. You log it. You move on. The identity slowly transitions from someone trying to prove something to someone managing exposure. This identity shift is quiet. There is no dramatic breakthrough. There is gradual reduction in reactivity. You stop checking the chart every minute. You stop moving stops. You stop increasing size after a win to feel momentum. You begin to value survival more than excitement. Survival before profit is not pessimism, it is professionalism. The trader who survives long enough gathers enough data to allow probability to work. The trader who chases emotional relief through size and frequency rarely reaches that horizon. The painful phase is not there to punish you. It is there to reveal where your nervous system is untrained. It shows you where you equate loss with inadequacy. It shows you where you confuse intensity with skill. If you remain in the process with small exposure and honest self-observation, the body learns. It learns that a stopped-out trade does not threaten survival. It learns that missing a move is not catastrophic. It learns that uncertainty can be tolerated. As tolerance increases, activation decreases. As activation decreases, clarity increases. And with clarity, discipline becomes natural rather than forced. You are not trying to become fearless. You are trying to become regulated. Fear may still appear. Loss may still disappoint. But they no longer control behavior. They are signals, not commands. This is the real transition from emotional trader to professional operator. The professional does not expect certainty. The professional expects variance. The professional measures success by adherence to process, not by the last outcome. When you understand this deeply, the painful phase changes meaning. It is no longer a period you endure while waiting for consistency. It is the training ground for stability. Each disciplined execution, even when it loses, strengthens the new identity. Each restrained decision when you want to react builds self-trust. Over time, self-trust replaces the need to be right. And when the need to be right fades, the market becomes quieter. You begin to see price movement as flow rather than judgment. You stop personalizing randomness. You accept that uncertainty is permanent. That acceptance brings calm. Calm brings consistency. Many traders say they understand that trading is a game of probabilities. They can explain risk to reward ratios. They can talk about win rates. They can repeat that losses are part of the business. But when a losing streak appears, their behavior tells a different story. Understanding something intellectually is not the same as embodying it under pressure. When 3 losses happen in a row, the body does not calculate long-term expectancy. It registers threat. The mind starts scanning for danger. Thoughts become sharper and more urgent. Maybe the market has changed. Maybe the strategy is broken. Maybe you are missing something obvious. This internal noise feels rational, but it is driven by activation, not analysis. In those moments, you are not fighting the market. You are negotiating with discomfort. The need to fix something quickly is often the nervous system trying to restore a sense of control. Control feels safe. Randomness does not. So you adjust a rule. You tighten a stop. You skip a valid setup because you want certainty. You take a marginal setup because you want relief. Both behaviors are attempts to regulate emotion through action. Action can temporarily reduce anxiety, but it weakens discipline. There is a quiet honesty required in trading that many people avoid. It is the recognition that even when you execute perfectly, the outcome can still be negative. Not because you failed, not because the strategy failed, simply because variance exists. Variance is emotionally uncomfortable because it removes the illusion that you can engineer consistent short-term rewards. In other areas of life, consistency is built through effort and refinement. In trading, Consistency is built through exposure and restraint. You are not trying to increase the number of correct decisions. You are trying to reduce the number of emotionally distorted ones. This is why position size matters more than most traders admit. When size is too large relative to your emotional tolerance, the body reacts as if something meaningful is at risk. Your heart rate rises. Your focus narrows. You become hyper-aware of every tick. In that state, you are biologically primed to intervene. You will want to close early to protect. You will want to move stops to avoid pain. You will want to increase size after a win to capitalize on momentum. All of this feels logical in the moment. It is not. It is physiology directing strategy. Small size creates space. It allows you to observe without urgency. It gives your nervous system room to learn that a loss does not equal danger. When danger perception decreases, discipline becomes easier. Not because you forced yourself to be disciplined, but because you removed the trigger that disrupted it. Many traders chase confidence. They want to feel certain before they act. But confidence built on recent wins is fragile. It disappears quickly when the next loss arrives. Stable confidence is built differently. It is built from repeated exposure to uncertainty without emotional collapse. You take the trade, it loses. You remain stable. You take the next trade. It wins. You remain stable. Over time, your brain begins to associate trading with neutrality rather than threat or reward spikes. That neutrality is the foundation of professionalism. There is also a deeper layer beneath fear of loss. It is the fear of being exposed as incapable. Trading is a solitary activity. There is no boss to reassure you, no colleague to validate you. When you lose, you are alone with your thoughts. If your self-worth is tied to performance, each loss feels like a verdict. This is where many traders quietly suffer. They do not just feel financial loss, they feel personal inadequacy. To move beyond this, you must separate identity from outcome. You are not your last trade. You are not your current drawdown. You are the quality of your decisions over time. When you evaluate yourself based on adherence to process rather than outcome, something stabilizes. A losing day where you followed your rules becomes a successful day of execution. A winning day where you broke rules becomes a warning sign rather than a celebration. This reframing is not motivational. It is structural. It aligns your measurement system with what you can actually control. Control in trading exists in only a few areas. Entry criteria, position size, risk management, emotional response. Everything else is external. The more you attempt to control what is external, the more reactive you become. The more you focus on internal control, the calmer you become. Calm does not mean passive. It means deliberate. There is a noticeable shift when a trader begins to value longevity over intensity. The focus moves from how much can I make this week to how well can I execute this month. The time horizon extends. Urgency decreases. Decisions slow down. When urgency decreases, errors decrease. Most destructive behaviors in trading are fast. Revenge entries, impulsive exits, size increases after wins, rule breaking after losses. They happen quickly because they are emotionally driven. Slowing down interrupts that pattern. Slowing down requires tolerance for boredom. Boredom is uncomfortable for many traders because it feels unproductive. But boredom in trading often means you are not over-engaging. You are waiting. You are letting setups form. You are not forcing action to feel involved. Excitement feels productive. Calm feels uneventful. Yet calm is where consistency grows. As you move through the painful phase, you may notice that your external results do not immediately improve. This can be discouraging. But internal metrics begin to change first. You hesitate less before valid setups. You recover faster after losses. You stop monitoring open trades obsessively. These are signs of regulation increasing. The market will still fluctuate. Your equity curve will still have drawdowns. But your internal curve becomes smoother. This internal smoothing is what allows probability to express itself fully. When you stop interrupting trades based on fear or greed, your edge has space to operate. When you stop increasing size to accelerate progress, you reduce the risk of emotional overload. Many traders sabotage their own development by trying to feel better instead of trying to become stable. They look for content that promises breakthroughs. They search for secret indicators. They compare themselves to others. All of this is an attempt to escape discomfort, but the discomfort is information. It tells you where attachment still exists. It shows you where control is still demanded. It reveals how much uncertainty you can tolerate. Instead of asking, how do I avoid this feeling? A more productive question is, what is this feeling teaching me about my limits? When you treat each emotional reaction as data, you begin to refine yourself the same way you refine a strategy. You observe. You adjust size. You reinforce discipline. You reduce exposure when unstable. You increase exposure slowly as regulation strengthens. This gradual scaling is important. Stability first, expansion second. If you attempt to scale before stability, volatility in your emotions will mirror volatility in your account. The goal is not rapid growth. The goal is sustainable participation. Sustainable participation requires humility. Humility accepts that you will be wrong often. It accepts that the market does not owe you reward for effort. It accepts that progress is slow and non-linear. When humility replaces ego, reactivity decreases. You stop trying to prove something to the market. You start cooperating with it. Cooperation in trading means aligning with conditions rather than imposing expectations. It means accepting that some days there is no trade. Some weeks are flat, some months are drawdowns. None of these define you. As this mindset stabilizes, trading becomes less dramatic. There are fewer emotional highs and fewer crashes. There is routine, there is structure, there is repetition. Repetition under calm conditions builds skill. Eventually you notice that you are no longer trading to feel something. You are trading to execute a plan. The emotional charge around each position weakens. Wins are acknowledged but not celebrated intensely. Losses are recorded but not internalized. This is the quiet consistency that most traders imagine but rarely describe accurately. It is not exciting, it is steady. And steadiness is built in the painful phase, not after it. There is a point in development where you begin to see that the market was never the true source of your instability. The chart did not create your urgency. The candles did not create your fear. They only exposed it. When you first started trading, you believed improvement would come from better analysis. You assumed that once you understood structure clearly enough, the emotional discomfort would disappear. But deeper understanding of structure does not silence the nervous system. It can even amplify pressure because now you believe you should perform better. Expectation increases tension. The more you think you should be consistent by now, the less tolerant you become of normal variance. A single loss feels heavier because it conflicts with the identity you are trying to build. You tell yourself you know better. You promise that you will not repeat mistakes. And yet under stress, you sometimes do. This repetition can feel discouraging. But it is not evidence of failure. It is evidence that conditioning takes time. The nervous system learns through repetition and emotional intensity. If you have spent years associating mistakes with self-criticism, that pathway will not disappear after a few disciplined trades. If you have linked financial fluctuation to self-worth, that association will not dissolve overnight. What changes first is awareness. You start noticing the surge before the impulsive click. You recognize the narrative forming in your mind after a loss. You feel the temptation to increase size after a win. This awareness is progress. Even if you still act on it occasionally, the gap between impulse and action becomes visible. Inside that gap is choice. At first the gap is small, reaction feels automatic. But as you continue trading with controlled exposure, the gap widens. You begin to pause. You take a breath. You remember that no single trade matters. You allow the discomfort to exist without immediately resolving it. This is emotional maturity in trading. Maturity does not remove emotion. It organizes it. Fear may arise, but it no longer dictates behavior. Excitement may appear, but it no longer expands risk. Disappointment may follow a loss, but it does not spiral into revenge. When this stability strengthens, you stop seeking emotional recovery through the next trade. Many traders unconsciously use trading to regulate mood. After a loss, they want a win to feel balanced again. After boredom, they want action to feel stimulated. After a good streak, they want to press advantage to feel growth. This emotional dependency keeps them reactive. A regulated trader does not use the market to feel better. The market becomes a place of execution, not emotional compensation. There is also an important shift in how you relate to time. In the early stages, you measure progress daily. You check results constantly. You want reassurance that you are moving forward. But daily results are noisy. They reflect short-term randomness more than long-term skill. As you mature, your time horizon extends. You evaluate performance monthly, sometimes quarterly. You understand that 10 trades tell you little. 100 trades tell you more. 1,000 trades tell you even more. Extending your time horizon reduces emotional volatility. When you accept that meaningful data requires volume, you stop overinterpreting short streaks. A series of losses does not alarm you as quickly. A series of wins does not inflate you as easily. You remain centered because your reference point is larger. This broader perspective is protective. It protects you from overconfidence, which can be as destructive as fear. Overconfidence often appears quietly after a smooth period. You begin to trust your intuition more than your rules. You slightly loosen criteria. You increase size just a little. It feels justified because recent results support you. But the market does not reward confidence. It rewards consistency. When a drawdown eventually follows overconfidence, it can feel shocking. Not because losses are unusual, but because they contradict the temporary identity of being in control. This cycle repeats until humility stabilizes your behavior. Humility in trading means respecting uncertainty at all times. It means treating each trade as independent from the last. It means keeping size consistent even when you feel sharp. It means reducing size when you notice instability rather than trying to trade your way back to comfort. Reducing size during instability is a sign of professionalism, not weakness. There will be periods when external stress affects your internal state. Lack of sleep, conflict in personal life, financial pressure. These factors lower emotional tolerance. In such conditions, the same position size that felt manageable before may now trigger activation. A professional adjusts accordingly. Instead of pushing through with the same aggression, you scale down. You protect capital. You protect mental clarity. You understand that survival is the primary objective. Profit is secondary to participation. Participation over time is what allows skill to compound. Compounding in trading is not only financial, it is psychological. Each regulated decision reinforces stability. Each disciplined stop reinforces trust in yourself. Each avoided impulse strengthens identity. Over months and years, this accumulation becomes visible, not as dramatic breakthroughs, but as smoother execution. You no longer debate every setup internally. You no longer experience sharp emotional swings. You operate within a defined framework. Framework reduces cognitive load. Saudi. When rules are clear and position size is aligned with emotional tolerance, the mind has less to negotiate. There is less internal conflict, less bargaining, less justification. Decisions become simpler. Simplicity is often mistaken for lack of ambition. In reality, it reflects clarity. The consistent trader does not need constant stimulation. They do not need to prove competence daily. They show up, execute, log results, and step away. Their life is not emotionally entangled with each trade. This detachment creates freedom. Freedom in trading is not the ability to make money quickly. It is the ability to remain stable regardless of short-term outcomes. It is the ability to take a loss without questioning identity. It is the ability to take a win without inflating ego. When you reach this state, trading becomes quieter internally. There is less narrative, less drama, more observation. You begin to trust the process not because it always wins, but because you understand its statistical foundation. You trust yourself not because you are always right, but because you know you will follow your structure. That trust is earned slowly. It is earned through sitting with losses without escaping, through resisting the urge to fix everything immediately, through accepting that growth in this field is non-linear. There will still be difficult periods. Markets change character. Their edges weaken temporarily. Drawdowns test patience. But because your identity is no longer fragile, these periods do not destabilize you as before. You respond with assessment rather than panic. Assessment asks whether rules were followed, whether market conditions shifted, whether size remains appropriate. Panic asks, how do I stop the pain? As long as panic drives decisions, inconsistency persists. When assessment replaces panic, professionalism strengthens. This is the deeper meaning of the painful phase. It is not simply a stage you pass through once. It is a recurring training environment. Each new level of capital, each new market condition, will test regulation again. But if you built the foundation correctly, these tests refine you rather than break you. The trader who survives long-term is not the one who avoids discomfort. It is the one who relates to discomfort differently. Discomfort becomes a signal to reduce exposure, to slow down, to observe, not a signal to act impulsively. In this way, stability compounds. At a certain stage, you realize that the goal was never to eliminate losses. The goal was to eliminate emotional instability around losses. That distinction changes everything. When you stop trying to build a system that never fails and start building a mind that does not fracture under failure, the entire experience of trading shifts. You no longer wake up hoping the market will validate you. You wake up prepared to execute. Execution becomes your anchor. You review your levels. So, you define your risk. You decide your size based on current emotional capacity, not on ambition. If you feel slightly unsettled, you reduce exposure. If you feel clear and rested, you maintain normal size. You do not increase size to chase growth. Growth is a byproduct of consistency, not intensity. During the session, you notice impulses arise. A trade moves quickly in your favor, and the thought appears to add more. Another trade stalls near your stop, and the urge appears to widen risk. These impulses are no longer commands. They are information. They tell you where attachment still lives. Instead of reacting, you observe. Observation creates separation. Separation weakens compulsion. Over time, the impulses lose force because they are not rewarded with action. The nervous system learns that discomfort does not need to be resolved immediately. This is how true discipline forms. Discipline is not rigid self-control. It is alignment between intention and behavior under stress. When your size is appropriate and your expectations are realistic, alignment becomes easier. When your expectations are inflated and your risk is aggressive, alignment fractures. Aggression in trading often hides insecurity. It is an attempt to accelerate validation, but acceleration increases volatility, and volatility amplifies emotional swings. The stable trader accepts gradual progress. They understand that a modest return achieved with calm execution is superior to dramatic gains achieved with emotional turbulence. There is also a shift in how you interpret drawdowns. Early on, a drawdown feels like regression. It feels like proof that you have not improved. Later, you see drawdowns as part of statistical distribution. You analyze them without attaching identity. You review data. You adjust if necessary. You continue. Continuation without emotional collapse is strength. This strength does not appear dramatic from the outside. There are no declarations, no intense motivation, just routine. Routine built on controlled exposure and honest review. You also become more selective with information. In the beginning, you consumed endless content searching for reassurance. Now you recognize that too much external input destabilizes internal clarity. You protect your focus. You refine a simple process and repeat it. Repetition builds depth. Depth allows you to recognize subtle shifts in your own state. You know when you are slightly impatient. You know when you are distracted. You know when you are tempted to deviate. Because you know yourself, you adjust before damage occurs. Self-knowledge is a competitive advantage. The market will always contain uncertainty. News will surprise. Volatility will expand and contract. But your internal environment becomes more predictable. You know how you respond to pressure. You know how to reduce that pressure through size and structure. This predictability reduces fear. Fear thrives in chaos. When your process is defined and your risk is contained, chaos diminishes. Even during volatile sessions, your exposure remains controlled. Losses are limited by design. Wins are allowed space within rules. You do not need to intervene constantly. Intervention decreases. As intervention decreases, results become more consistent with the underlying edge. Or, you are no longer distorting outcomes through emotional interference. You are allowing probability to express itself. This is where many traders finally understand that the painful phase was never about punishment. It was conditioning. It stripped away the need to control the uncontrollable. It revealed how much of your behavior was driven by fear of being wrong. It forced you to confront the reality that effort does not guarantee immediate reward. From that confrontation came humility. Humility allowed you to reduce size. Reduced size allowed you to remain calm. Calm allowed you to follow rules. Following rules allowed your edge to manifest. The cycle reversed itself. Now when you lose, you feel a brief sting, but not a spiral. When you win, you feel satisfaction, but not urgency. Your emotional amplitude narrows. This narrow band of reaction is where long-term performance lives. You stop measuring progress by excitement. You measure it by stability. You notice that you recover quickly after sessions. You notice that you do not obsess over charts at night. You notice that trading occupies less psychological space in your life. Less psychological space means more balance. Balance keeps you from over-identifying with short-term results. You have interests outside the market. You maintain routines that regulate your body. Sleep, exercise, structure. These habits support your nervous system, which in turn supports your trading. Everything becomes interconnected. You understand that trading performance is not isolated from personal regulation. A tired mind reacts more. A stressed body tightens faster. So you manage energy as carefully as capital. Energy management is part of risk management. At this stage, your goals simplify. You want clean execution. You want adherence to structure. You want to protect capital. Profit is welcome, but it is not pursued with desperation. Desperation leads to force. Force leads to mistakes. Patience replaces force. Patience is not passive waiting. It is active restraint. It is the willingness to let conditions align rather than manufacturing opportunity. It is the confidence to do nothing when nothing is present. Doing nothing is often the most difficult skill for traders to master. It requires comfort with inactivity. It requires trust that opportunities will return. It requires belief that missing one move does not threaten your future. That belief develops only after you have survived enough cycles to see that markets are endless. There is always another setup. There is always another week. There is always another year. Scarcity thinking fades. When scarcity fades, urgency fades. When urgency fades, clarity increases. When clarity increases, execution stabilizes. This is the transformation from reactive participant to regulated professional. You no longer enter trades seeking relief. You enter trades because they meet criteria. You no longer exit trades to escape discomfort. You exit because rules define it. You no longer adjust size based on recent emotion. You adjust based on structured evaluation. Structured evaluation replaces impulse, and in that replacement, consistency quietly emerges. It does not arrive with dramatic announcement. It reveals itself over time in smoother equity curves and calmer internal states. You look back months later and realize that the intensity that once defined your sessions is gone. In its place is steadiness. Steadiness is not glamorous. It will not impress those looking for rapid transformation, but it is sustainable. It allows you to remain in the game long enough for skill and probability to compound. This is the identity shift that matters. From emotional trader seeking validation to regulated professional managing exposure. from reactive to deliberate, from outcome-focused to process-centered. When you embody this shift, the market becomes what it always was, a neutral environment of fluctuating prices. It is no longer a mirror for your worth. It is no longer a source of emotional spikes. It is a field of probabilities. And within that field, your role is simple. Define risk. Size appropriately. Execute consistently. Review honestly. Protect capital. Repeat. The painful phase was the training ground for this simplicity. Without it, you would still be chasing intensity. With it, you have built stability. Stability is the edge that endures.